Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. I've often mentioned how the bright green highlighted August 2022 to date uptrend, currently at 1909, how it did not act so much as a resistance but more as a nuisance. Well, 3 weeks ago, this broken bright green uptrend, along with the darker green highlighted short medium moving average, currently at 1899, managed to erode the bullish incentive enough that the purple upper time you see on my daily chart, which is currently at 1851, well, it capped the market. This also happened 2 weeks ago to a lesser extent, and early last week as well. Now, I drew this purple late February to very early July bearish Andrews pitchfork, this purple one, 3 weeks ago, in the hope it might provide some idea of the recent bearish angle of attack. I did mention at the time that I'd be happy to finesse this to a shallower bearish shift pitchfork with the same move if it became appropriate. But right now, it once again seems there is no need for this finessing. Though I do know that this has now dropped down under, the upper time has dropped down under the previously mentioned broken bright green uptrend and green short medium moving average, and thus has been liable to upward pressure. However, for the moment, we are still exhibiting lower highs, a keen bearish sign, but the lower lows have sort of petered out, and we seem to have some support at or just under the 21st century absolute Fibonacci line at 1809. This support has been tested on and off since mid-May, and the room for maneuver now is so tight that either the support will have to break, or the purple upper time will have to break, but by realistically the end of this week. So next week I might have something interesting to say about all of this. Now, I did put out there some 3 weeks ago that the action since mid-April might be forming a possible double bottom. This pattern was and is not complete, and I've stated over recent weeks that we would need to see how the action develops over the next few weeks. I still stay by this point, though unless we see a move up this week, then I am minded not to regard it as likely. I was very clear on the wording of this point 3 weeks ago when I said, and I quote, "Please note this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine but definite." And that's the end of the quote. This really just leaves the purple highlighted bearish Andrews picture as the main operational pattern in this market, unless it needs finessing. Ice Europe, white sugar in London. The changeover gap in mid-April between 613.40 down to 580.30 saw prices exit head lower through various stratified levels, and in late April, mid-May to form another different pattern, bearish descending triangle. The subsequent exit below and out of this pattern in mid-April gave us a primary target in the 544.80 zone and a secondary, much harder to reach target X1 down in the 497.60 zone. 13 weeks ago, prices moved down and reached the primary target via the means of a mid-April to mid-May bear flag. The activity in heading lower, much like New York sugar, allowed me to draw a new pattern and speculate on two other possible outcomes. Firstly, I drew 3 weeks ago a start of April to start of July bearish Andrews pitchfork highlighted in purple on my daily chart. The market is presently just underneath the overhead upper time, currently at 523 even. Much as in New York sugar, I've been hoping this bearish pitchfork might provide some definition to the recent bearish angle of attack, and I was willing to finesse this to a shallower bearish shift pitchfork for the same move if it became appropriate, but right now it again doesn't seem that I need to, though I do think we may be coming to a cusp on which I will speak more on shortly. Another point I made 3 weeks ago was a longer term one. I pointed out that we had the opportunity to make a monthly key reversal in July, and we subsequently did so. A monthly key reversal down. We have seen some activity towards the downside, if limited. However, prices in early August reached down to levels not seen since March 22. The final idea I put out there 3 weeks ago, was to perhaps regard the action since mid-April forming a possible double bottom. Over the last couple of weeks, as my phrase implies, this pattern was not complete, and I recognised last week that time was running out for this idea. It was, as I said back then and since, and I quote, "Please note this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine but definite." End of quote. This week again, this idea is so far away that unless something drastic happens this coming week, I will drop it for next week's commentary. This just leaves the purple highlighted bearish Andrews pitchfork as the main operational pattern in this market. However, last week I noted within this purple bearish Andrews pitchfork a new pattern, a pattern within a pattern like a Russian doll. It is an early July to date bearish channel. I've outlined the lower bear channel line in bright red, currently at 477.10, and I utilised the purple upper time, currently at 523 even, as the upper bear channel line. So, what have we in the way below that might hold up any declines? Well, we have a penetrated band of congestion between 509.5 to 517.80, and we are now into our third week of testing it still. The market has so far not managed to push down through it. Most of it is 1 to 3 years old, but we also have some congestion here from 2017. This also applies to the thin 490.10 to 489.10 congestion further down, just below target X1. We then have the neckline extension of the April 2021 head and shoulders neckline, currently at 481.30. I'm not sure how good this last one is, but I have highlighted it in dark blue on my daily chart, so I must think there is something behind it. Sugar white premium spread. I've previously spoken here some while ago now, but at length, about a big picture item here seen on my weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with the lower time currently at 147 even, tested, breached, and now broken on the downside. 18 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London Sugar Month changeovers, but it nevertheless set in motion a lower market, though prices took their own sweet time in getting down below the lower time. So, we are now again testing the lows of early to mid-October last year, down in the 115 3/4 to 116 even area. Indeed, where we have been for the last 3 weeks, and again this week. This is the next support zone. Though when prices were down here back in October last year, they were at the same time just above the dark blue lower time, which we are not today. Hence, though we have been held up here for a while, this support may not be as strong as seen back then, but I'll give it some time and see. Overhead, we have the two 50% Fibonacci lines of the July 2019 to September 2022 move at 131.25 and the August 21 to September 22 move at 128.75. Looking below, there are lesser Fibonacci supports further down at 107.75 and 104.5, but I'm not sure how good these are. The next support of note would be the lows of the first week of February 2023 at 83 even. The mid-February low then at 83.75 and 83.75, and the early February low at 81.75. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.